Inflation is something we all feel in our wallets, but have you ever wondered how it impacts your long-term savings and investments? For years, people have relied on traditional saving methods, but with inflation consistently eating away at the purchasing power of money, those strategies might not be enough. As inflation continues to rise, understanding how it affects your savings and investments is crucial for securing your financial future. In this video, we'll break down the impact inflation has on your long-term financial goals and share insights on how you can protect your wealth. 10. Inflation erodes purchasing power. At its core, inflation means that prices rise over time. When inflation occurs, the same amount of money buys less than it did before. For example, $1,000 today may be enough to cover your monthly expenses, but in a few years, that same $1,000 might only cover a portion of those costs. This is particularly important for long-term savings. If your money isn't growing at a rate that outpaces inflation, you're effectively losing purchasing power. Over time, this small erosion can add up to a substantial reduction in your wealth. For example, if inflation averages 3% per year, the purchasing power of $1,000 will decrease by 3% annually. This means that in 10 years, your $1,000 will be worth around $740 in today's terms, making it harder to maintain your standard of living or reach your financial goals. 9. Traditional savings accounts fall behind inflation. For many years, people have kept their savings in traditional savings accounts. However, with inflation running at 2 to 3% per year, most savings accounts offer interest rates that are much lower. In fact, in many cases, the interest you earn on your savings account is not enough to keep up with inflation. For instance, if a savings account offers 1% interest and inflation is 3%, you're still losing money in real terms. In an environment where inflation outpaces savings account interest rates, your money loses value. While keeping money in a savings account may provide short-term security, it is not an effective strategy for long-term wealth growth, especially when inflation is consistently higher than the returns on your savings. 8. Investments are affected by inflation. Inflation also plays a significant role in investments. When inflation rises, the real value of your investment returns can diminish. For example, stocks may provide an average return of 7% per year, but if inflation is 3%, your real return is only around 4%. Similarly, bonds that offer a fixed interest rate might seem appealing, but if inflation is higher than the bond yield, you're actually losing money in real terms. The relationship between inflation and investments is crucial to understand, especially for long-term investors. While stocks and real estate tend to outpace inflation over the long term, not all investments are created equal, and inflation can erode the value of certain assets. Understanding which investments are better positioned to perform in an inflationary environment is vital for maintaining the growth of your wealth. 7. Impact on retirement savings. For those saving for retirement, inflation is one of the biggest threats to long-term savings. Over a span of 30 to 40 years, the effects of inflation can significantly reduce the value of your retirement fund. If you're putting money into a 401k or IRA with the expectation that it will grow over time, inflation can impact how much you'll actually have available when you retire. To combat inflation's impact on retirement savings, you need to invest in assets that provide higher returns than inflation over the long term. Many retirement accounts invest in stocks, bonds, or mutual funds, but if your asset allocation is not adjusted to account for inflation, you could face a shortfall in retirement. A diversified portfolio, with a mix of inflation hedging assets like real estate or commodities, can help protect your retirement savings from inflationary pressures. 6. Real estate and inflation. Real estate is often considered a hedge against inflation. Historically, real estate values tend to increase with inflation, making it a solid investment for protecting wealth over time. As the cost of materials and labor increases, so too do home prices. This makes real estate one of the few investments that has traditionally kept pace with or outpaced inflation. However, the relationship between real estate and inflation is not always straightforward. High inflation can lead to higher interest rates, which can make it more expensive to borrow money for purchasing homes or investment properties. In these cases, real estate may not offer the same level of protection against inflation as it does during periods of lower interest rates. Understanding the broader economic environment is crucial when investing in real estate as a long-term strategy. 5. Stock market, a long-term solution for inflation. Stocks are often touted as a good long-term hedge against inflation. Over the long term, the stock market has historically provided returns that outpace inflation. Companies tend to adjust their prices as inflation rises, which allows them to maintain profit margins and grow revenue. This, in turn, leads to higher stock prices, which benefits shareholders. While stocks can offer inflation protection, they are not without risk. Stock prices can fluctuate wildly in the short term, and in periods of economic uncertainty or market downturns, the stock market can take a hit. That being said, a well-diversified portfolio of stocks, particularly those in industries that have pricing power, can offer growth that outpaces inflation over the long term. 4. Commodities and inflation protection. Commodities like gold, silver, oil, and agricultural products are often considered safe havens during inflationary periods. Gold, in particular, has a long history of holding its value when the purchasing power of fiat currencies declines. While commodities can act as a hedge against inflation, they are not risk-free. For example, the price of oil can be impacted by global geopolitical events, and agricultural products can be affected by weather conditions. In addition, commodities often don't provide income like dividends or interest, which makes them less attractive for income-seeking investors. However, when inflation runs high, commodities can be a useful tool for protecting the value of your investments. 3. Treasury inflation-protected securities. One of the most direct ways to protect your portfolio from inflation is by investing in Treasury inflation-protected securities TIPS. TIPS are U.S. government bonds designed to protect against inflation. The principal value of TIPS rises with inflation, and they pay interest twice a year based on the adjusted principal. As a result, the interest you earn on TIPS increases with inflation, providing a reliable income stream that grows with rising prices. TIPS are considered low-risk investments because they are backed by the U.S. government, and they provide a direct inflation hedge. However, they may offer lower returns than other assets like stocks or real estate, and their performance is tied to inflation rates, meaning they may underperform during periods of low inflation. 2. Inflation and the cost of living. Inflation doesn't just impact savings and investments, it directly affects your cost of living. As prices rise, everyday expenses such as groceries, utilities, and healthcare become more expensive. For individuals on fixed incomes or with limited investment portfolios, inflation can be particularly challenging. It's essential to account for inflation when budgeting for long-term financial goals. For example, if you plan to spend a certain amount each year in retirement, inflation will erode the purchasing power of your retirement income over time. Planning for inflation means increasing your savings rate and considering investments that will outpace inflation in order to maintain your lifestyle and meet your financial objectives. Mitigating the effects of inflation. There are several strategies you can employ to protect your savings and investments from the impact of inflation. First, diversify your portfolio by including assets that tend to perform well during inflationary periods, such as stocks, real estate, and commodities. Second, consider investing in inflation-protected securities like TIPS or other bonds that adjust for inflation. Third, ensure that your investment strategy is long-term focused and incorporates the potential impact of inflation on your financial goals. By taking proactive steps to protect your wealth, you can mitigate the effects of inflation and ensure that your savings continue to grow over time. So how can you protect your long-term savings and investments from inflation? Diversifying your portfolio, focusing on growth assets, and utilizing inflation-protected securities can all help safeguard your wealth. Remember, inflation is a long-term challenge, but with the right strategy, you can still come out ahead. If you found this video helpful, be sure to subscribe to stay updated on more financial tips and strategies. Share your thoughts and questions in the comments below. How do you plan to protect your savings from inflation? Let's talk. Thanks for watching, and I'll see you in the next video.